Hi, everyone. I'm Rick Bensignor. Today is Tuesday, April 5th, and welcome to this week's In the Know Trader Show. On tap this week, we're going to do things, we're going to mix things up. Let's say that. We're going to mix things up a bit compared to what we normally do. We're going to start off with a market overview and take a look at the charts of the Dow, the US 10-year, and gold. And then we're going to spend the entire rest of the episode reading an article together about one of the legends in the industry, Stanley Druckenmiller, who had been at George Soros's firm, learned a ton from George, is one of the best portfolio managers ever to play the game, with a long-term track record of over 30% annual returns. There's just very few, if anybody, who can match that type number in this industry. And I recently came across an article about him, and it is so interesting that I want to show you the article, and literally we'll kind of read through it together and talk about the different issues that he brings up about how to be successful here. So that's what today's show is going to be. To sign up to get my weekly tactical trader report or the monthly 7-Eleven report, go to inthenowtrader.com. And by the way, this is of note for any of you who own spiders in your account and do passive investing. The 7-Eleven report was designed by me to find a way to outperform the S&P, but by only using as my universe to invest in the 11 macroeconomic sectors of the market. So in other words, XLK for technology, XLE for energy, and so on. The 11, let's call them XL ticker symbols. And what we do is we're never in more than 7 of the 11 at any one time. We rebalance once a month at the beginning of each month. And just to give you an idea of how well I am doing relative to the market, we outperformed by 20 basis points in March. In 2022, for the first quarter, we outperformed by 1.71%. So that's, if you annualize that, that's 6.8%. And I'm not saying that you should annualize it, but that's the rate at which we're outperforming already this year. For our fiscal year, which starts every August 1st, we're ahead by 2.62% this year. And since starting this 20 months ago, on August 1st, 2020, we are outperforming by 616 basis points. These are huge numbers, and put us in the top 10% of anybody who plays this game. So if you are interested in beating the market and yet having getting to do some own personal allocations to do that, which is a really simple task, because again, it's only once a month with minor tweaks, that is the way to do it. So sign up for that at inthenowtrader.com. Okay. We are going to take a look at just a couple of charts. So let's start off with the Dow. This is a daily chart of the Dow Jones. You can see today we kind of had a spike high. At least we're trading mid-range. We're trading right at the conversion line. We've been around there for the last few days. NASDAQ is and S&P are, I think, slightly above theirs, but this at least on a daily chart, is what we're seeing. And we did see last Friday's low and Monday's low right against the top of the cloud. So there is some support there. For me, I'm still thinking that we're from right here, you're basically exactly halfway between the next support area of significance to me, which is 342 in the diamonds, and resistance up at 354.5-ish. So there isn't a huge vig to playing here. There's no edge really. I'd much rather be a buyer down towards there, or even the bottom of the cloud zone, than doing stuff in here right now. Let's look at the US 10-year, which is again flying today on the highest move so far. So when we zoom into our chart here, this is the weekly chart. You can see we're currently trading at 2.54%, just off of today's highs of 2.56. We are still into resistance in the sense that this is the weekly propulsion exhaustion level was at 2.5. There's a TD/ST line here at 2.53, and a new full propulsion exhaustion level at 2.62. So anywhere up in here, I'm not selling bonds right now because of that. We're into some theoretical resistance for the in yield terms. However, you want to remember, you don't want to fight the Fed, and the Fed has made it very clear what they're doing and how much that they're going to need to increase rates. So alluding back to something we talked about a few weeks ago about not being the hero when you trade in the market, but being a consistent warrior. Heroes don't often live to play another day. That is not your and should not be your intent in this market. You want to make sure that you ensure long-term survivability, and one of the key aspects to that is not fighting the Fed. And we will, you'll see that Stanley Druckenmiller talks about that a bit and how important it is. The last chart we'll take a look at is the gold chart. Let's see, here it is. So here's the weekly gold chart. So you see a month ago, we tested all-time highs in the GLD. We've been off since then. We're kind of just hanging out here in this 180-ish neighborhood, give or take. We have held on to this trend line that we broke out from. At least the lows are holding above there. And I want to make sure that we basically stay above the middle Bollinger Band. After having gone into a narrow range here on the breakout towards the upside, I think in general, the middle Bollinger Band is your inflection point that you want to stay above on pullbacks. So that's what I'm looking at. And you know, if you're a long-term investor in gold, which I am, I do not trade gold generally. It is a very difficult market to trade on a short-term basis. But I am investing in gold. I still think the fundamentals are decent for gold, although some would not agree with that. I think the fundamentals are still good, and I am playing for the fact that gold will ultimately take out these highs here and push higher. So I am staying in it, and I've been long gold for years. And my thought is I will continue to hold onto the metal. All right, let's get to the crux of the matter. And what I'm going to do here is something, again, I haven't done before. And this is actually an article that is on a website called Zero Hedge. And literally, I want to kind of walk you through this because Stanley Druckenmiller, as I said, is an absolute legend in the industry. How many people do you know who have over the last 3 decades have over 30% annual returns? It's beyond impressive. And he's never had a single down year and only 5 losing quarters out of 120 quarters. The man knows how to play this game. So let's read this together. And I'm pretty sure you can find this on Zero Hedge, even if you don't have a subscription to it. I think it's most of the stuff they have is free. And let's take a look at some of the traits that Stanley possesses. So they talk about mental flexibility. And what is that? Well, that's the ability to come to a conclusion of which way a market's going, but have the flexibility to change your mind when the market proves you wrong and without being stubborn about it. So that is a very important characteristic to possess as a winning trader. Independent thinking. What do I think about that? Well, independent thinking really means that you have the ability to not only do your own research, but be willing to go against the crowd. And you know, for me, I'm almost always going against the crowd because we're buying when others are selling and we're selling when others are buying. So of course you need to time that well. But certainly I put myself in the category of an independent thinker and tend to stay away from what the crowds are thinking takes. And you really need to be a competitor because it is you against everybody else when you play this game. Tireless inquisitiveness, which means you never say, oh, I know there is everything to know. You never give up the learning process, both in life and in the markets. And I remember that I used to work with a gentleman at Morgan Stanley years ago. Many of you know his name. It's Byron Wien. He is an icon on Wall Street. And I remember even at, I think it was Byron's 70th birthday party, He said that he comes into work every day with the intent of learning something new he didn't know. And that's someone who had been in the industry already over 40 years. And lastly, a deep self-awareness, which to me goes to understanding your strengths, your weaknesses, being willing to face those so that you can incorporate them into how you put on your positions, when you put on your positions, when you get out of your positions. You really need to understand yourself and know what your faults are when it comes to playing the game, because the more you are self-aware, the better you can do about handling those prior situations that normally would put you into a bad situation mentally and emotionally, and learning to deal with it in a much better way. Interestingly here, so as we get deeper into this, on what moves stocks. So Druckenmiller was one of the people interviewed in Jack Schwager's book, The New Market Wizards. And basically what he says is, even today, now that book's over 20 years old, but it still applies. Many analysts still don't know what makes their particular stocks go up and down. And I find that fascinating, but I kind of knew it. But, Stanley is in print about this from over 20 years ago. Analysts in the industry realize that if they're pretty much Me Too players, they'll survive and have a job. But so often they have absolutely no clue on what moves their stocks, because they think it is 100% about fundamentals. And when you get a technician sitting down next to a fundamental analyst, the fundamental analyst will say, "You don't even know what my company does. Who are you to tell people where to buy and sell it? You have no clue about this company." And the reality is that technicals have a huge portion of the reason why stocks move. And the fundamental analysts don't usually understand that. They don't know how to read charts. They don't want to know how to read charts. And they really are clueless when it comes to why their stocks are moving like they are, because they're bullish on a stock and the stock's moving down, and they'll just get more bullish instead of realizing that the game has changed and that their fundamental analysis is old analysis, and that smart money is already 3 steps ahead of what they're thinking. The financial world is chock full of noise and nonsense. And Stanley talks about this relating to also corporate earnings. Earnings don't move the overall market. It's the Fed that moves it. Focus on the central banks and focus on the movement of liquidity. Most people in the market are looking for earnings and conventional measures to do their fundamental analysis, and it's the liquidity that moves markets. If you have any doubt about that, look at what the market has done since the great financial crisis that bottomed in March of 2009. The Fed has continuously put money into the system, barring a very short time that they tried to withdraw some where they were hawkish and tightened. Now we have clear indications from them that we are in a tightening mode that will be significant. That means we are reducing liquidity in the markets. If you reduce liquidity in the markets, you can't possibly perform as well going forward as you have in the past. So there's still several, we see them all the time on business television, the mega bulls out there telling you we're going to 5,200 in the S&P, 5,500, 6,000, eventually, yes, there's no way to think that going forward, the S&P is going to make the returns, the average annual returns like it has since, the last 5 years, then once it goes into hawkish mode. It's just not likely. So getting 20 and 25 and 30% returns like we've seen over the last few years is just highly, highly unlikely when they're taking liquidity out of the market. They created the bull market. They'll take it away. It doesn't mean we have to go into bear market. It doesn't mean we have to fall apart. It simply means that the liquidity that drove the market is not going to be there in the same way at all in the future. And therefore, you cannot expect moves to be anything like they have been in the past. The Federal Reserve is the biggest lever on liquidity. That's why a trader needs to constantly keep an eye on what the Fed is doing. Let's see. On a single stock level, here's what Druckenmiller says. Very often the key factors related to earnings. And this is particularly true when it comes to bank stocks. Chemical stocks, however, behave very differently. And the industry works on very different measurements. So it's really important to understand the stock market tends to anticipate the developments of each industry, not what has occurred, but what is going to happen down the road. The market, we all know, but we often forget, is a future discounting mechanism. So when you see the market down, it's because in the future, people are already anticipating that it is going to go down, and the same thing on the upside. So if we know that the Fed is in tightening mode, it's very hard to make the case of being a mega bull. Doesn't mean we have to go down. It just means we're not going up anything close like we have. And given the run the market has had in the past, to me, I said this morning on a different podcast I did, even if we made new highs, to me, they're very short-lived new highs. There's just no reason to think that we're going to stay up at new highs without having multiple chances to be buyers at lower levels too. Focus on the future, not the past. Another thing that sets Druckenmiller apart is his willingness to use anything that works, as in any style or tool, to find good trades and to manage them. Now, one of the best traders, investors ever to live says the following: another discipline I learned that helped me determine whether stock would go up or down is technical analysis. Now, most of the famous people on Wall Street will tell you it's all about fundamentals and that technical analysis is a waste. And the old joke that they like to talk about, which is, have you ever seen a wealthy technician? Well, here is one of the greatest investors ever telling you that technical analysis is important. I never use this is a quote, I never use valuation to time the market. I use liquidity considerations and technical analysis for timing. Valuation only tells me how far the market can go once a catalyst enters the picture to change the market direction. So Druckenmiller used a bunch of different approaches: fundamental, macro, technical, sentiment, to broaden his view of the battlefield. This was also very contrary to how Wall Street thinks. How do you make outsized returns? Well, as it says here, he threw conventional wisdom outside or out the window. Instead of placing a lot of small, diversified bets, he practices what he calls the big bet philosophy, which consists of deploying a few large, concentrated bets. So he says, well, the first thing I heard when I got into business, not from my mentor, was bulls make money, bears make money, and pigs get slaughtered. He says, I'm here to tell you that I was a pig. And I strongly believe that the only way to make long-term returns in our business that are superior is by being a pig. I think diversification. Now, every broker, every person in the industry who represents the money management side will tell you should have a diversified portfolio. He thinks it is probably the most misguided concept anywhere there is. And if you look at the great investors, whether it's Warren Buffett, Carl Icahn, Ken Langone, who obviously founded Home Depot, they tend to be very, very concentrated in their bets. They see something, they bet it, and they bet the ranch on it. And that's the kind of way my philosophy evolved, which was, if you see only maybe 1 or 2 times a year, you're going to get something that lines up so well. But when you do, and it really excites you, you go and you bet a good chunk of money on it. He says the mistake I'd say 98% of money managers and individuals make is they feel like they got to be playing in a bunch of stuff. And if you put your eggs in one basket, then watch the one basket carefully. I'm a little in between here. I don't believe in being broadly diversified, but at the same time, I don't believe in putting all your eggs in one basket. And I've talked about this before, where I know people who have a very significant portion of their money in crypto. And yes, you can make a killing if it's right. But if it's wrong, and this whole idea doesn't play out the way you think it does, and it hasn't yet proven to be what people think it'll be, we just don't know yet, it's too early, then you're going to lose a boatload of money on one concept and one speculative play that you got into, that you bet a ton of money in. So not even Stanley bet 50% on any one play, but he might have been concentrated into 5 to 10 at any given time. Again, he was a long-term investor, so he wasn't watching the charts on a daily basis. He would have a macro idea, and when he put it on, he had done a boatload of research to do it, and then put it on and would get bigger over time. Now, important stuff. Seth Klarman, another well-known trader, but not to the level of, let's say, a Druckenmiller, said avoiding loss should be the primary goal of every investor. Now, that doesn't mean you don't lose money, but it means that you stick around. You don't bet so big that you ever blow yourself up and your days of being able to trade. The avoidance of loss is the surest way to ensure a profitable outcome. So that means keep losses small. Doesn't mean run for the hills the minute a trade goes against you. But if the reason you got into the trade is no longer valid, to me, you don't stick around hoping it comes back. He said the importance of striking when the iron is hot is something Druckenmiller learned when he was at Soros. And Druckenmiller says, I've learned many things from Soros, but perhaps the most significant is that it's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. The few times that Soros ever criticized me was when I was really right about something and I didn't have enough money going in it. In other words, he hadn't maximized the opportunity. So Soros would get mad at him that he put on a bet, but he didn't bet big enough. Soros wanted big bets, big concentrated bets. This is what people tend to do too on the money management side on the hedge fund industry. Once a portfolio manager is up, let's say 30 or 40%, he books his year. He basically closes down, doesn't want to give back what he's made. And Druckenmiller says the way to truly attain superior long-term results is to keep going after you're up 30, 40%. Don't get so conservative that you just want to say, hey, I had a solid year, 30% return, 40% return. It's a terrific year. He would say, go for the 100% year. Keep playing, go to double your money. If you can put together a few years like that, then you really achieve long-term outstanding returns. Here's an important information he talks about when it comes to handling losses, because we all have them. And it's probably one of the most important things that you can do is figure out how to handle losses. So he said the day before the crash in '87, Druckenmiller switched his book from being short to 130% net long because he thought the market sell-off was done. But he quickly realized from what price action was the day before the crash that that didn't feel right. And he switched his book and actually went short the day before the crash. So he did this all during the day, changing his mind. And he says the practice of having strong opinions, but weakly holding them, meaning you have the flexibility to change out of them. It's difficult, but you really need to be able to do that to have success. So this is again, this is available on Zero Hedge. We kind of walk through the article now, but I think it's really important that you read this. In fact, if I go to the top of my screen here, there's the actual link itself. So it's you go to zerohedge.com/markets/lessons trading great Stanley Druckenmiller. And hope you enjoyed this episode of In the Know Trader. I'm Rick Bensignor. We'll see you next week.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.